Hi there, my name is Mark Pfeiffer, and in today's presentation I'm going to go over how to use put options in the Cash Flow Board Game 202 version. First thing you should know about put options are that there's a buyer and a seller involved in this transaction. The buyer in this case has the right but not the obligation to sell the stock at the strike price by the future date. And for this option, he pays a premium. The seller has the obligation to buy the asset at the strike price if the buyer exercises the option. In return for selling this option, the seller will receive the premium from the buyer. Alright, well, let's look at a concrete example here from the cash flow board game to make sense of this. So here you've drawn a card. OK for you put option. Pay $2 per share now in multiples of 100 shares, limit 5,000 shares total, to sell OK for you at $35 per share when anyone draws an OK for you card. On the same turn, you may sell at $35 per share and buy at the other card's price. Puts expire at the end of your third following turn, if not exercised. I'm going to show you here what the game card looks like. So this is what your game card looks like in 202. And the options worksheet. You have call options and you also have the put options section right here. It puts it together nicely here for you so that you just need to enter in all the information and then you can make the calculations yourself. So what I've done is I've gone ahead and put this into an Excel format right here. Same information from that worksheet that you just saw right here and put into Excel. So the stock symbol was OK for you. And in this example, I'm going to take 1,000 shares. The cost of option per share, going back to our example, was $2 per share. So we put $2 here. Total amount paid is the product of the number of shares times the cost of the option per share. 1,000 times $2. The strike price, as indicated on the card, was $35 a share. We'll put that in here. The information on this side you'll use once a new card has come up for OK for you at a certain price. You would look at today's price and then you would then calculate whether you could have a gain on that, and then you could determine whether you wanted to exercise your option or not. So in our example here, I've gone over that entry into the worksheet. Here's the next card that comes up. Let's say you pull this card. OK for you drug company goes broke. OK for you bankrupt due to lawsuits over alleged harmful products. All shares worthless. All owners of shares and calls erase all shares of OK for you. All puts and shorts owners take a profit at new price of $0 before trading is halted permanently. Today's price is $0 and no trading is permitted. So many times in reality, a company will go bankrupt and a lot of people will lose money here. And the reason is they have a long position. They've bought the share and they're holding on to it hoping that it will go up in price. What a put option does is it allows you to make money when the stock's price goes down. So this is a really good example, and you'll see how you're able to make money when OK for you drug company has gone bankrupt and is worthless essentially at $0 per share. So going back to our spreadsheet here, today's new price $0. The price gain is the strike price minus today's new price. Essentially what this means is you can purchase the shares at $0, and because of your put option, it enables you to sell those shares for $35 per share to the buyer. And the buyer in this case was the seller of that put option. So going back to our PowerPoint presentation, you, the buyer, who purchased this option, this put option from the seller, are now able to purchase the shares in the open market at $0 per share and sell them to this seller for $35 a share. So the price gain is $35 minus $0, which is $35. The total amount that you receive is going to be the price gain, which was $35, times the number of shares you had, which was 1,000. So you're going to receive $35,000 through exercising this put option contract. To calculate what your profit is, you would, from the $35,000 that you received, subtract the $2,000 that you paid for this option contract, giving you a total profit of $33,000. Not bad. So I wanted to show how this works visually here for you, so that you can see how it works. Here we go. So the blue line is showing your payoff. At $0, let me back up a little bit here. So on the vertical axis, we're showing profit, the amount you receive, profit and the amount you receive. And on the horizontal axis is share price. I put the strike price here, which was at $35 per share, which is right here, this line. $0 is what you receive if the strike price is 35. That's what your payoff would be. Now, profit is what is, I would say, most important to look at, because you have to pay a $2,000 premium for this option contract. If the stock's price doesn't change, or if the stock's price goes up above $35 a share, you're going to lose just the amount of money you paid for that option contract, which was $2,000. To break even, the shares price would have to go down to $33 a share right here. That's where you'd break even. Now at $0, your profit was the $33,000 that we had shown on the Excel spreadsheet here. $33,000. And the total amount you received, the payoff, was the $35,000. So this is just showing you how visually your downside is limited to the premium that you paid, and your upside does have a limit here. But the good thing about a put option is you can see it as insurance. Insurance in case the worst happens and the company goes bankrupt. You'll be able to make some money. So I hope this has been helpful for you. If you have any questions, please leave me a comment down below, and I'll answer them as soon as I can. Have a great day. Bye.